historical anomaly, which has been consistent, in Susan's point, and every one of the last 7 recessions, that kind of thing has preceded it. Let's get the read from market watchers Craig Smith and Aaron Gibbs and Scott Martin. Scott, what do you think of that? I mean, she laid out a very good sort of a table here, what has happened in the past and what could be happening again. What do you think?
Yeah, it was a great chart, Neil. Now, the funny part about that chart is if you take it back to the 90s, which, if we all remember, was a pretty good growth scenario, it was a tightening Fed environment, a good budget situation, certainly, too. The yield curve flattened, too, then, my friends. And it didn't go inverted, as we've talked about, many times so far this year that's looking like it's going to do. But a flattening yield curve still can occur amongst a very good growth environment. So I think the Fed is actually playing this one pretty well with respect to how they're looking at the economic data, where their inflation target is, where if you look anywhere in inflation, GDP deflator, CPI, it's what, 2% and change? The Fed has a lot of room here to hit one more hike in June and wait to see what the data tells them to do for the rest of the year.
All right, now we're going to get an opportunity now to get what's behind the Fed's thinking when the chairman speaks with reporters, Aaron, and he might telegraph more rates to come, might kind of hint at the status quo. What do you think?
I think right up until we saw the producer production index as well as the CPI numbers come out, I would have said there's no way we're going to have a 4th rate hike. But the fact that the PPI really surprised us, so this is producers, so this is before it gets to consumers, that really jumped from 2.8 to 3.1. That's a big, so that's more forward-looking, but that's something that we're
when
really
you're saying
indicate.
Jump to 3.1, that's over the 12 prior months, right?
Exactly,
Go ahead.
and that's a big change in May versus the prior trend.
So is it your read from that the Fed almost has to act for fear of being caught, behind?
It's so forward-looking. They don't have to react at this stage.
Right.
And, this would definitely be that 1-rate hike. It's if that continues and then we see that trickle down into the consumer prices, because we have a slow upward trend right now, but that's a potential indicator that the consumer could then see a higher rate as well. And that might cause a potential hike in December that's not exactly expected at this point.
Craig Smith, if stock traders are worried about this, that, as I often say, they have a funny way of showing it. They slough off trade war battles. They slough off, nasty comments between ourselves and the Canadians. They slough off a North Korea agreement that some say wasn't what we thought it would be. In other words, this tendency that markets have to worry and sell has been anything but. So they're not seemingly too worried. But what do you make of that?
Yeah, they're not, Neil, and you can see that in the Fed Fund futures this morning. And look, I'm not so concerned about this rate increase. I do believe there are going to be 4 rate increases. If you go back to the beginning of the show, you were talking about real rates should probably be somewhere 3.5%. Right. And now when you're looking at a 2.8% CPI and a 3.1% PPI, I think that this chairman's going to be emboldened to be able to take the steps to try and normalize rates because he's got a good economy to do it. As your other guest said, look, we've seen flattening in the yield curves before and it didn't lead to a recession. But here's what I'm focused on, Neil, and I think this is the most important thing. I want to see what this statement says. I want to look for 3 things. Number one, is he going to say the Fed is going to remain somewhat accommodative? Is the Fed going to remain accommodative? Or is the word accommodative going to be taken out of the language? Also, I want him to talk to the politicians and saying, look, we've done everything we can financially. Now you guys have to deal with the fiscal reforms that are necessary in order to sustain this growth. And until we do that, Neil, we're just whistling past the graveyard.
Well, so are they, to your point. Scott Martin, I'm wondering, too, whether the Fed chairman will weigh in on these threatened trade tariffs. So far, no one's feeling because they haven't come to pass yet, but they're supposed to, and the Canadians are supposed to respond July 1 with tariffs of their own. Also, the Chinese lining up some planned tariffs of their own. If that happens, where are you on this, the inflationary threat or the slowdown threat that comes from?
Yeah, I mean, any tariffs, especially for goods that come into the U.S., Neil, is certainly an inflationary concern to the U.S. consumer. Now, the Fed is going to watch those things and watch those geopolitical developments, but they're not going to talk about them because, you know, the Fed likes to stay out of that arena. But, gosh, guys, I mean, I don't want to go Dennis Rodman on you guys, but I got to tell you, this is a great day in Fed speak. I mean, I'm serious. I'm holding back tears, I guess, because this is a rate hike that has been long coming, and it's just as Craig said, this is normalization of interest rates. As Aaron said, there could be a couple more this year. I'm in the camp that there's going to be another one in December. There's 4 meetings left, by the way, kids, after this meeting today where they could hike a couple more rate hikes in there. So to me, this is a Fed that's right on the curve. For one time in history, at least in the most recent years, opposed to the Yellen Fed, they're right on the curve here, and that's a good thing for the economy. You know,
Aaron, Scott was referring to the 4 more meetings. We're told that Jerome Powell, the chairman, is going to favor a presser after each one. And normally, we never expected hikes or cuts or anything like that where there wasn't a press event. Now he's going to hold one every 6 weeks, I guess. So what do you make of that? Because that adds to the anxiety, doesn't it?
It does and it doesn't. And one thing that
you got to tell us, because we have a special graphics package with alarming music if that happens. So
play it.
In general, transparency actually calms the markets. It's the unknown that causes the volatility. So if we're getting more information from them, that's actually most likely just going to keep the markets a little smoother. As we've seen, even with Yellen, the more transparent and the more open she was, and we started seeing the dot plots, you actually saw smaller reactions to when the Fed finally raised rates because the market had already incorporated it into their expectations. So for me, I'd say the more transparency, the less volatility.
Interesting. Craig, are you buying in this environment?
Actually, I'm not, Neil. I'm on the sidelines. This is a little bit too rich for my blood. Wow. However, I do believe that we could see another increase from here as it relates to productivity and subsequently prices in the stock market. But keep in mind that I think Powell is a different chairman. I mean, this chairman is going back to the original mandate of the Federal Reserve: full employment, you know, keeping prices stable, i.e. no inflation, and moderating long-term interest rates. It was only Bernanke and Ms. Yellen that put the 4th mandate in, that it was our responsibility to buy assets back in order to prop up the stock market so that people had confidence so that we get back into consumer spending. So I think Powell's got a full plate. I think he has a lot of leverage. And keep in mind, Neil, if he does raise rates to 3%, now he's got some ammunition. In the event we do have a slowdown, he doesn't have to use those extraordinary tools like asset repurchases. He can simply lower interest rates, make it more conducive to borrow.
Built up a little bit of some wiggle room there. That's a good point. Guys, I want to thank you all very, very much. Very good read on all of this. All right, in the meantime, we're getting a sort of a good cop.